a model based on a regression analysis that was built on the scientists that were working in the bomb in the 1940s. The scientists needed a way to try to simulate the results of a nuclear explosion without actually detonating a live weapon. They needed to check variables in terms of like wind speed, population. These are the type of things that they were doing in the 40s. Well, this model that they developed, this simulation, which is now called a Monte Carlo, was developed from these scientists, and it was such a renowned simulation and such a tool that the casino industry is adopted. In the famous city of Monaco, Monte Carlo is known for gaming. That's why it's gotten the name Monte Carlo. So casinos use this simulation for risk and return when it comes to their table games. They know when you walk into that casino what the risk and reward is for each and every game you play. They know that roulette has the highest odds to the house. So, and we know how profitable the casino industries are and how it works when you actually break down risk and returns. So what this report tries to do is it takes that same information or same tools, a statistical analysis, and as an advisor, we change our variables. So we look at what are the future taxes going to be, what's inflation rates going to be, what are the investment returns likelihood over the next 30-year period based on historical rates of return. What is your expenses going to look like in retirement? Income, Social Security, pension, assets. So we plug all of this information in, and what it tries to do is assign us a probability of success. What is the likelihood on a scale of 1 to 10 that you're going to run out of money? This report wants you to be above at 80%, but for our clients, we always like to have you above 90%. So if you look at page 4, you can see a little pie chart. We've all seen this little pie chart. So what this is basically saying is based on this particular sample for Sam and Sally, that their current asset allocation strategy, which is 65% stocks, 5% cash, 30% fixed income, this is their asset allocation strategy that's going to allow them to achieve their investment goals. If you can flip to the next page, you see a little chart that says 90%. It's a little, I don't know what you call that. It looks like a little scatter plot, but it's got percentage likelihoods on the left. Oh,
likelihood is
here. I can't see it up here, but you can see this. So this is telling us right here that this client, Sam and Sally, had greater than a 90% probability of not running out of money based on the information that we put in this analysis. You can see the orange line below it, 80%. We never want to get below that orange line. Then we have issues whether or not we can fund the retirement that we particularly want. So let's talk about how we built it. Go to your next page. This is where we put the information in. This is where I work with my clients. We sit down, we try to really determine what their goals are in retirement. So Sam and Sally, they told me, and I knew you weren't going to be able to see it, so that's why I printed it out, but they told me that they needed $75,000 after tax in their pocket for the rest of their life. So based on their current standard of living, they need that money after tax. So basically, if you look at a 25% tax bracket, that's $100,000 pre-tax. So we model these results based on assuming that they're going to be in a 25% tax bracket for the rest of their life. Now, hopefully when you're in retirement, your W-2 income is down. You're not going to be in that type of tax bracket, but we want to kind of plan for the worst and hope for the best and assume that you will be. Given that the deficits that we're running now as a country, it's safe to assume that tax rates at some point in time in the future are probably going to have to rise like they were in the 70s. So we try to build that into the analysis. It also tells me that their daughter is going to go to college for 4 years. They're going to assume that they're going to spend $36,000 per year. That's per year of college expenses. Their son's going to go to college. They need to put in $36,000 for him for 4 years. So it tells me their retirement age. Both of Sam and Sally want to retire at 65, and this is their current allocation, which is a moderate asset allocation over here. And surely this is your investment strategy. Investment strategy has very little to do with the type of investments you own because those will always change. What's going to be consistent is the risk that you're taking with those assets. So that's what we do as an advisor to make sure that we're modeling your results to get us in the appropriate asset allocation. And then we can go out and find the best-in-class investments for you. Go to your next page, page 7. This is where we gather our information as an advisor. So I need to know Sam's salary. What are you making now until retirement? What is Sally making now until retirement? We look at Social Security income. That's going to start when they retire in 2025. That will continue for the rest of their life. We're looking at what they're currently putting in their 401ks. What is the company matching? So we're building all this information in. Education savings. They have the goal for the kids' education. What are they actually saving each and every year to hit those goals for the education? So we're, and when it comes to planning, it's only as accurate as the information you put in it. So we work together and we make sure that we update this each and every year. When you get your Social Security statements, and maybe your kid's already finished a year of college, and so we can start adjusting to make sure that we're keeping on track. So move to page 8. So on the other page, I showed you that they wanted to live off $75,000 after tax for the rest of their life, and based on the probability, it shows they have a 90% probability. But I'm showing down here on a conservative level, this is an 80% likelihood, 50% likelihood, and 33% likelihood. So this depends on markets. On a conservative level, they could actually live on an 80% probability of $98,000 after tax. If the market does really, really well, 50-50, they can do $125,000 after tax. And if the market does extremely well, we're showing that they can live off $145,000 after tax. So we're putting in different variables in there based on the market conditions. Your next page is a little busy. Most important part here is if you look at the top, the black line, that's just when things start to happen. Retirement happens in 2024. That's the black line continues for the rest of their life. Education for their kids is just that 4-year period. Down at the bottom, you see the 0, where it says portfolio value. On the left, you see a 0. The objective is to keep your portfolio value above that 0. And if you look at the black, that's the 80 to 95% range. So that 80 to 95% range is where this is what we're going to use as our probability. We don't want to focus on the 50 or the 33. More than 8 to 9 out of 10 times, this is the range of your portfolio over a period of time. So let's look at the next page. If you look at page 10, this is where it gets really detailed. So as we start building this statement, Sally and Sam, I can show them each and every year the income, their taxes that they're going to spend, which is 25%, their goals and expenses, and net amount, what they're pulling out of their portfolio. So if you see the top boxes up there, it's just showing you, hey, we're not retired yet, we're making money, we're saving money. Now this is, the top box is assuming they don't have any pre-retirement lifestyle right now, so really focus on the bottom down here where it's retirement. That's where I put the numbers in. So 2025, Sam and Sally are both 65. They have $73,000 in income coming in, that's Social Security pension. They pay $15,000 in taxes. Their goal is $105,000. So as you see, they started off winning $75,000 after tax, but in 2025, $105,000 is now equivalent to $75,000. So we're growing that with inflation. So your goals will continue to go up with inflation. If you see the net amount, this is the amount they have to pull from their portfolio each and every year to supplement their income. So you can see they're pulling out 48, 49, 50, all of these numbers every year. So even with that said, to end it, if you switch to page 12, you can see, let's just pick a year here. Let's pick 2031. Sam is 71, Sally is 71. They pulled out $56,000 that year out of their portfolio. If you look above that, they pulled out all of that money above it as well. Well, you can see on an 80% likelihood, on a probability at 71, they're still going to have $2.15 million in portfolio value. So that's the job of the advisor, is take your assets, give you an income and growth strategy, give you the income that you need, but grow the assets at the same time. So this is a projection of what it does. Now this is, we have to make some assumptions, of course, rates of return, but we go back and we look at historical rates and say, what has this risk profile done over the last 50 years? And with some minor adjustments, then we can say on a confidence level of what we think the actual ending results will be. So, and this is what we do for our clients. We sit down every year, we update it. What are your goals? Did you pay off your car? Did you buy the truck that you wanted? Go on vacation? We plug all of this in, and we know where we are each and every year. And then basically the job is just to make sure that we're staying on track. So that's what we do for our clients, and it's very detailed. Now there's this page, this thing is probably 80 pages, so I just took out, I just really wanted to get down to kind of what we put in as far as the detail. But it breaks down retirement calculations, what you have to take out for R&D requirements each and every year for your IRAs, a lot of complicated stuff, but that's it in a nutshell. So anybody have any questions?
Is this information generated via a questionnaire?
You know, a lot of firms do. They send you out a questionnaire and say, hey, fill this out and turn it in to me, but I don't think that's very effective. What I try to do with my clients is I'm going to sit down with you and I just want to have a conversation with you about these things, and I'll go through and ask you the questions that I know are important. So it takes, you know, about an hour for the most part, but it's really detailed. I want to know everything about you. I want to know, my job as an advisor is to be your partner. Somebody that, you know, if you're making a big financial decision in your life, if you're buying a house, selling it, whatever it is that affects the rest of your life, Merrill Lynch and I want to help you make that decision. So that's what it's about. Madison?
Do you have a typical age of a person that you want to see, or does it have to be 250K?
So, you know, I'm working with the high net worth team now, so really my minimum account levels are $1 million. We really are not taking on any clients right now unless they have $1 million or more. So, you know, who is that? What does that mean? Well, you know, I'm looking at the CEOs and the high-level executives. These are people that are your maybe FedEx, International Paper, these type of people that have been in their 401ks for over 30 years and have a significant level of work. However, with that being said, I'm willing to help anybody. I think it's the cost of doing business to get in front of people, because you help people, they know what you do, they know other people. So I don't mind helping people. I mean, for me, I get a lot of gratitude out of helping people grow their assets and hit their financial goals. So, you know, originally the account sizes were minimum of 250. They've kind of moved up to $1 million. However, I'm not going to turn down anybody. So if you've got somebody that you know needs help, send them to me. And if I can't help them, I'm going to be honest with them, and I'm going to get them in front of the right people. We have people at Merrill Lynch that can help them, but I will guide them and send them in the right direction. Make sure that they're getting good advice. Mr. Terry.
In the example there, how old were they when they started? What was their initial investment?
So for Sam and Sally, I mean, this is just kind of generic numbers that I put in. If you look at the potential wealth current value on page 13, you can see the top in parentheses. It says current value $550,000. So you've got somebody with a potential wealth of $550,000 today, 2014. They're investing in an income and growth strategy, and we can show them, based on a moderate asset allocation, that we can take that $550, provide them with the income that they need, and still have over $2 million in assets at the end of the period. So there's a lot that goes into it. I mean, it's substantial. You know, it's time in the market that gives you the return. You can't time it. You have to get in there, and we know from a time value of money calculation, just on a modest rate of return, even 7% return can be quite tremendous. So, okay, I won't take any more time. I know that took a while, so outside of that.